Thanks, Eloise, and morning, everyone. Great to be able to speak to you all today, and thanks for joining the session. I thought I'd use this time to give an update on what we're seeing from a macro perspective, and what we think that means for both the mortgage market and for brokers and for customers. I'd start by saying that the environment is generally looking a lot more positive than it has done for a while. I've got quite a few charts on this page, but I'll probably start with swap rates, which are obviously a huge focus when it comes to mortgage pricing. And I think there's a few sort of key points to call out in terms of where we are now from a swap rate perspective. One of the things that we've seen as we've sort of moved through this year is that swap rates have been a lot more stable. What that means is that the outlook for base rate is a bit more predictable. We're starting to see 2- and 5-year swap rates as well converge. What those things mean is that reduced volatility in terms of swap rates, less variation in terms of mortgage pricing, and that is obviously good for everybody. Good for customers because there's more certainty, less rework for brokers around rebooking activity, with people wanting to get the lowest rates for their mortgage, and obviously less rework for lenders as well, in terms of rates moving around so regularly and by so much. What that means is that reduced volatility should really translate through to brokers having more time to try and acquire new business rather than spending time on rebooking of rates, which is obviously a good place to be. It's not just swap rates either that we focus on within the mortgage market. Obviously, base rate is a key part of it as well. Trackers are linked to base rate, but also I think a more important metric is affordability. So most lenders in some way have their affordability calculations linked to base rate. With base rates starting to reduce, obviously we'll get sort of the double whammy of rates coming down, but also affordability improving. So the maximum lending typically that lenders will provide to customers should start to increase as that base rate comes down, which is obviously going to give us a tailwind too, as we see rates reduce. Sort of looking a little bit more broadly as well, the other things that give me confidence in that improving outlook are HPI. So we can see that on the page. HPI has now been pretty sort of consistently either slightly positive or flat for almost a year. We're showing the seasonally adjusted numbers on the page. Actually, if it's unseasonally adjusted, I think it's positive over that period. So HPI is in a reasonable place and on a good trajectory. Obviously, inflation's dropped to broadly to 2% to target, which is good. One of the metrics that I really like to focus on is the number of homes coming to market, because I think that just gives a signal for demand and supply in the market. And I think as we see more properties come to market, you typically see more buyers as well come to market, and it starts to become more of a buyer's market. That's now at a 7-year high, which I think is a really positive metric moving into next year. One of the items not on the page, but also is in a really good place, is consumer confidence. So consumer confidence is also starting to increase. What that does is point to a willingness of consumers to spend, to invest, to make those bigger purchases. And the recent increases we've seen in consumer confidence really starting to point to increased consumer spending over the next period, which again sort of just shows those changing attitudes and people being more open to making those bigger purchases. I think all those things together, so reducing base rate, more stable swap rates, improving HPI, inflation broadly on target, really positive housing market in terms of properties available for sale, really giving us all the ingredients for a strong market moving into 25. So really positive on that. If we move over to the next page, we can also see some of those things starting to play out in terms of what we're seeing now in the market. So first chart shows the mix of purchase business in the market. What we've seen this year is that purchase has really been the driving force behind increased market that we've seen year on year. We've not seen that remortgage market really increase. It still remains relatively muted. And the chart on the right sort of shows that the market has grown year on year, but it's more due to consistency in terms of the size of the market rather than a big growth on what we saw previously. And that consistency in the size of the market, given that year on year growth, a lot of that is down to those stable swap rates. So last year we saw a lot of volatility in swap rates. They particularly increased over the summer, and you see that direct correlation to the market reducing at the same time as rates go up. What we've seen this year is rates have generally edged down, but been a lot more consistent. So moving around within a much narrower corridor, whereas previously we were seeing quite big increases, quite big decreases. So that stability has really helped create a sort of slightly larger but more consistent market. And like I said, driven by purchase. When we start to look forward into next year, and when I think about where I think the market is going to go and create opportunities, I definitely think remortgage activity is going to be the piece that sort of gives the market more momentum next year. So fully expect purchase activity to remain, strong and remain a really sort of powerful part of the market. But I do expect that remortgage segment of the market to start to heat up, particularly as customers start to move off of the higher sort of peak post mini budget rates, and equally as the overall property market gets hotter, start to wonder around where they've locked in sort of higher rates for 5 years, whether it starts to make sense to actually look to break some of those 5-year deals to both secure a lower rate, but also take advantage of that broader market that's out there. So I think purchase will remain strong, remortgage activity likely to start really to heat up as we go into next year. And then what we see on the bottom left is total mortgage market stock, and what we've seen there is last year market reduced. We were expecting, or sort of press were expecting HPI to be declining, customers really suffering through cost of living, interest rates obviously accelerated pretty quickly. All that meant that customers were paying down debt, reducing overall market, and probably a little bit of nervousness around where the housing market and property prices were going to go. Obviously, we've touched on now it's a much more positive position, and what we've seen as we have gone through the first half of this year is actually the total market has moved back to growth. So it declined last year. We've seen the total market grow about 10 billion in the first half of this year. You'd broadly expect that to continue in the second half, so 20 million-ish growth for the year broadly. But what we see if we look back a little bit further is typically the mortgage market grows year on year by about 40 or 50 billion. So although the market seems to have turned a corner and we are starting to get growth back overall, there's still sort of more runway to go in terms of growth. And I definitely expect that's the trajectory that we'll start to see as we move into next year, which is more of that sort of longer term trend growth. So 40 or 50 billion growth in the market rather than sort of the muted growth we're still seeing come through. What that means for Kensington and for Barclays as well is that we're really positive around the outlook for the mortgage market, and we absolutely see it as a place that we want to grow our presence, support brokers, and do more business together. I think sort of on the bottom right of the page, we're trying to call out some of those macro risks which do still remain. But I think as long as the government and the economy can sort of navigate through some of those residual risks that are still out there, I think sort of no news is good news, i.e. that we can continue on the sort of trajectory and with the momentum that we've got now. I think that puts us in a great place from a market, from business perspective, to have a really strong end to 2024 and carry a lot of momentum into 2025. So as I said, I think really positive outlook in terms of where we think the market's going to go. Really positive in terms of mortgage market's a place where Kensington particularly are looking to grow and to take advantage of those positive market conditions. yeah, I think you know, it's great to be in this position, particularly after what's been a fairly challenging period, I think, for most. So hope everybody found that helpful, informative. Happy to receive any questions on any of that. Thanks again for joining, and I'll pass back to Eloise.